Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving the MA specimen that is given on the ACCA official website, and these are the extra MTQs from that MA exam. So let's get started. All right, so the exam total consists of three section B type questions. So we'll go sequence by sequence. So we have some background information given to us. The director of Donny Company is reviewing the performance of one of its division. The following information is available for the year ending in its South Division. So we have information about the South Division. We have the sales given to us, we have the operating profit, and we have the capital employed also. Now, the South Division operates in the food retail industry. The total retail industry sales for the year ending 31st March 20X9 was 1250000. Okay, so now let's have a look at task 1. So, with regards to task 1, we have to calculate these 5 blanks over here. So first of all, we have to calculate ROI, and please be very careful with the rounding of instructions that are given to you. And I can also see that the percentage sign, the dollar sign times is already written. So when we are just starting off, you are in the knowledge level, it's very important to understand this, that you do not have to put a percentage sign on your own when you type out your answer over here, because the percentage sign is already given, and then the rounding off instructions are also equally important. Otherwise, since the exam is completely marked by a computer, if you are not following the rounding off instructions, the answer will be marked wrongly by the computer, even though your answer is correct, but you have not followed the rounding off instructions. So let's get started. First of all, we have to calculate the ROI. So with regards to ROI, we know that the formula for the same that we have learned is operating profit divided by your capital employed. So we do have our operating profit of 700, and we also have our capital employed of 3500. So we just have to perform this calculation over here, right? So this will be 700 divided by 3500, and then to convert it into a percentage, I'm going to multiply this by 100. So when I carry this calculation out, I can find out that my answer comes out to be a straight 20%. So this is itself to the nearest whole number. So I'll just enter 20 over here. So this is my answer. Now let's move on to the next one. The return on sales, which is operating profit margin, we have to calculate that. So it is already given that we have to find out the return on sales, and we have to see it according to the operating profit. So operating profit is already given as 700, and the sales that we have had is 50,000. So again, your answer is going to be 50,000, which is sorry, first in the numerator you take the operating profit, which is 700, and you divide that by sales of 50,000, and then you multiply this by 100 to get a percentage over here. Now if I just calculate this on my calculator, 700 divided by 50,000 and multiply this by 100, so this gives me 1.4%. So that is the rounding of instruction also says that it has to be to one decimal place. So I'm just going to enter 1.4 over here, because it is itself till one decimal place. Now let's have a look at asset turnover. So we know that the formula for your asset turnover calculation is nothing but your sales divided by how much capital you have employed. So basically, you see that according to how much money you have put in the business, how much the business is able to generate revenue from that money that has been invested. And this is, found out in terms of times. So times is already given over here. So let's put the values in the formula. So we have to divide the sales with our capital employed. So sales is already given to us as 50,000, and our capital employed is 3,500. So again, I can carry out this calculation over here. My sales is 50,000, and then 3,500 is my capital employed. So if I just carry out this calculation on my calculator, I will get an answer of 14, and this is itself a nearest whole, so I do not have to round it up or down. So I will just simply say 14 over here. Now we have to find out the residual income using an imputed charge of 12% per annum. So your residual income is nothing but how much you have earned in terms of operating profit, and then you subtract your cost of capital. So cost of capital you have to take at 12%. So what we will do over here is simply first, we'll look at our operating profit. So the operating profit that was given to us was $700. And then we just have to subtract from it 12% on our capital employed. So we already saw that the capital that we have employed in this case over here is 3,500. So I will just take 700 and subtract 12% of 3,500 from here. So if I just find out how much 12% of 3,500 is, this comes out to be 420. So 700 minus 420 becomes my answer. And if I just carry out this calculation, I will get my answer as 280. So that is what my answer will be over here. And I can type my answer. So this will be 280. Now let's have a look at the market share. So how do we find out the market share? We compare that how much is the sales that we are doing and how much is the whole size of the market. So with regards to that, the sales that we have done is 50,000 and the entire industry sales were 1250. So our answer will be simple, 50,000 divided by 1250,000. So if I just carry that out on my calculator, I will get my answer as 4%, and itself this is a whole number. So we are done with task 1 now. Now let's get on to task 2. So task 2 says, is each of the following an advantage of residual income as a measure of divisional performance over the return on investment? So let's read the statement one by one. It helps in comparing performance of the managers of of divisions of different sizes. So what will happen over here is we have to select no, because when you come at residual income only looks at how much is the income that is remaining, but it does not take into account how much is your initial investment is that you have taken, right? So that is why this statement has got to be no. Now let's have a look at the second one. It makes divisional managers aware of the cost of financing their divisions. So when you are using the residual income approach, definitely what we did right above also, we subtracted the cost of capital, right? So definitely when you are using the residual income approach, the managers will definitely be aware of how much the cost of financing their division is, because that is how residual income is arrived at. The cost of finance is subtracted, so they will be careful with that. Now, the next statement is, it is directly related to the net present value. Now, this statement is also true, because the more your net present value will be, the more will be the residual income. Now let's have a look at the last statement. It ensures that managers will select projects with positive net present value. Now this is not correct, because even though you know the whole focus of the managers over here will be to have a residual income. So that is how they will not really be careful with uh, the NPV is positive or not. So that is not insured over here, right? So now let's move on to the task 3. We are done with task 2. Task 3 says, which two of the following are non-financial indicators that can be used to measure performance? So non-financial, right? That is what something that we have to consider. So profit is again financial. Then return per machine per month is again financial. Now, non-productive hours per month is something that is not in terms of money. This is some hours that have not been productive by the employees. So yes, this can be a non-financial indicator. Now, defects per product per month is again something which is of a qualitative nature. It tells you about the quality of your product. So that is why this is also a non-financial indicator. Now let's have a look at the second question. We are done with the first question now. So with regards to the second question, we have a background and we do have 5 tasks over here. So Kin Company produces a single product. Each finished product requires 3 kg of raw materials. The raw material costs $6 per kg. You are given the following information. So they prepare budgets on a quarterly basis. Each quarter consists of 13 weeks with 5 working days per week. It is company's policy to maintain inventory of finished goods at the end of each quarter equal to 5 days demand for the next quarter whenever possible. It is not possible to hold raw material inventory because of its perishable nature, but it is possible to hold inventory of its finished goods at any level. Okay, so these are the forecast sales that we have given, and then the selling price, and Kin Company aims to maximize its profits. So the first task that we have over here is to calculate the budgeted opening and closing finished goods inventory for quarter 1 to the nearest 1,000 units. So first of all, let's work out for our opening finished goods inventory. So please be very careful over here. It is already given in 1,000 units. So whatever your answer is, you have to remove 3 zeros from that and then enter your answer. So let's first find out the workings. So the company, has a policy that it will hold the inventory of 1 week's of the next 1 week sale of the next quarter. So this is what was given to us over here at yes. So then we see that how much is the demand for 1 week. So it is given to us that 1,950,000 is the forecast sales for your entire quarter. So, and it is also given that there are 13 weeks in each quarter. So I can simply take 1,950 over here, 1,950,000, and if I divide that by 13, I will get my how much I'm supposed to keep for 1 week. So if I carry out this calculation, I will get my answer as 150,000 units. So now 1,000 is already given, so I will only enter 150 over here. Now let's have a look at the closing finished goods inventory. So when the quarter will end, so in the in the beginning of the quarter 2, they will have again 1 week's worth of inventory for how much they have predicted for the quarter 2. So for the quarter 2, I can see over here that they have predicted 2275. So 2275,000, and again dividing that by 13 weeks to find out for 1 week. So for 1 week, if I carry out this on a calculator, I will have my answer as 175,000. So I will only enter 175 over here. Now let's move to task 2. Task 2 says the desired closing finished goods inventory in quarter 4 is 150,000 units, and we have to calculate the budgeted number of units to be produced in quarter 4 to the nearest 1,000 units. So we all know that how much our production will be, so that will be equal to sales, how much you are selling in that period, plus how much your closing inventory will be, and minus subtracting any opening inventory that you already have. So this is something that you are going to be producing. Now, sales in your quarter 3 that we have. So quarter 3 sales are already given to us as okay. So here we have to find out the figure for quarter 4. So we will have a look at how much is our sales going to be in a quarter 4, which is 2275,000. So 2275,000 plus our closing inventory, and closing inventory is also given to us as 150,000 units, and then we subtract the opening inventory. So sales we just saw over above was 2275,000, and then I am adding the closing inventory. Closing inventory is given over here, which is 150,000 units. So I'm just adding that 150,000 units and subtracting the opening inventory. Now, how will I find the opening inventory? So that will be based on the closing inventory at the end of quarter 3, which is equivalent to 1 week of quarter 4 sales. So quarter 4 sales is 2275,000, and if I divide that by 13, I will have it for 1 week. So this will be subtracted from over here, and if you solve this, you will get 175,000. So solving this entire equation, 2275,000 plus 150,000 minus 175,000 will give you your answer as 2250,000. 000 is already given, so I'm just going to enter 2250 over here. Now let's have a look at task 3. Kin Company budgets to produce 3175,000 units in quarter 3 to meet the sales demand and to achieve a closing finished goods inventory of 175,000 units. So, what is the budgeted cost of raw material usage in your quarter 3? And we have to bring it to the nearest dollars, nearest $1,000. So, first of all, how much our raw material usage will be? So that will be how much we have budgeted to produce. So to produce, we have budgeted 3175 units, that is given over here, and then we have to multiply that by how much kg is each unit using. So it was given that 3 kg of raw material is used in uh, every unit, and then how much is the cost per kg? So that is 6. So we do not have to do much over here. We simply take this 3175, yes, so 3175,000 and multiply that by 3 kg and multiply that by $6. So this will give you your answer, and if you carry out this calculation, you will get your answer as 57150,000. Again, 000 is already added, so I will just enter 57150. So with this, I have done my task 3 also. Now the finished goods inventory is not really relevant over here. How much we are budgeting to produce, that much will be how many raw materials we are using in that quarter. So that is why this 175,000 figure has been totally ignored. Now let's have a look at our task 4 and 5. So task 4 over here says that the company's raw material supplier has informed them that due to restrictions on the manufacture of the material, the supply to the company will be restricted to these many kgs per quarter for the foreseeable future. Beginning from quarter 1, Kin Company decides to purchase the maximum amount of material available in each quarter and build up inventory of finished goods whenever possible. So, under these restrictions, the budgeted opening finished goods inventory in quarter 3 will be these many units. So, we have to calculate a revised closing finished goods inventory for quarter 3, taking into account the restrictions on the material supply. So, now we know that this is the maximum amount of material that is going to be available for us. So, now let's find out how many units will we be able to make if we are only supplied with this much of raw material. So, this is the raw material that we will be getting, and per unit takes 3 kg. So, how many units can we make over here? We will be able to make 2200,000 units. So, this is the number of units that we will be able to produce during this time. So, if you take into account the opening inventory of 325,000 units, the company, let's have a look at the quarter 3 sales. So quarter 3 sales are only going to be 3250. So that means that they have an inventory of 325,000 already, and they will only be able to sell 2525,000, right? Because if you subtract that from the Q3 demand, you will get 2525,000. So this means that your closing inventory will definitely be 0 because you have utilized all the raw material to meet your sales. So you will have no closing inventory, right? Now let's have a look at task 5. Which two of the following would not help Kin Company overcome problems caused by the restriction in your material supply? So we have to select which will not help them. So let's read at the options. Seeking alternative sources of supply. This will definitely be a helpful strategy. Requesting a trade discount. Now, this is something that will not, enable them to solve the problem of the restriction on this supply, because even if they get it at a lesser price, they are still getting it in the limited quantity, right? So then let's have a look at using of more efficient use of material. Now this will also help them because this will save them material, and eventually they will be able to produce more of the goods. Now, last point that we have over here is using the EOQ model. So, when they are using the EOQ model, again, they will be optimizing their order costs and their inventory holding costs. Again, this will not be helpful in solving the problem of your raw material supply. So, with this, we have come to an end to question number 2 also. Now, let's have a look at task 3, the question number 3, which is the last for this extra MTQs that are given by ACCA. So let's have a look. Prancer company uses standard costing to control its costs and revenues. A standard cost card is only for its only product is given below together with the standard cost operating statement for the last month. So we do have the cost card given to us, and we have the cost operating statement also. So these are the variances also given to us. Now we have to select the appropriate words, phrases, or numbers to correctly complete the commentary on the last month's results. So Prancer company uses standard dash costing. So let's have a look at what our options are: marginal or absorption. So let's have a look above. So let's have a look at the variances that are given. So sales volume variance. So if we have a look at this, this has been valued at your standard profit 600,000. So it has been valued on this figure. So only when you are using the absorption costing, only then you are going to be valuing your sales volume variance on your standard profit. So that is why your answer over here will be absorption costing. Now let's have a look at the second blank. In the last month, actual selling price was dash standard. So we have options lower than, equal to, or higher than. So let's have a look at what the information is given over here. All right. So we do have the sales price variance also. So we can see that there's a favorable sales price variance. Sales price variance basically measures that how much your sales price should have been and how much it actually was. So if it actually was greater than how much it should have been, then only you get your favorable variance. So that means the actual selling price was higher than the standard. So now let's have a look at the third blank. Actual units sold were dash budgeted. Okay, so we have to tell how much more or how much less were they than the budget. So let's have a look at the information again. We have to find out the actual units over here. Right. So we see that there's a profit of $50 that we make on each product, right? So we can see that the sales volume variance is adverse, which means that we have that we have sold lesser units than we had budgeted. So we can see that the sales volume variance is valued at your standard profit. So 60,000 adverse is your volume variance, and 50 is the amount of profit that we are making per unit. So if I divide 60,000 by 50, I will know how many units have I sold lesser than I thought I will be selling. So 60,000 divided by 50 gives you 1200. So that means 1200 actual units were 1200 less than your budget. Now let's have a look at the fourth blank. The fourth blank wants us to find out the actual sales revenue. So going back to the information provided to us again, the actual sales units that we can find out over here can be nothing but we can find that out by dividing the standard profit, standard profit on actual sales divided by how much our standard profit is. So basically, if you just take this figure over here that you know, you have a sales standard profit on actual sales. So you have attained 60,000 lesser sales volume. So the sales volume variance that is given to you is 60,000 adverse. So that means that I can say that if I divide the standard profit on actual sales by my standard profit, I can find out that my actual sales units are 10,800. Now, when I have a look at my sales revenue, that means it is nothing but number of units, which is 10,800, multiplied that by the selling price. So multiplied by 150. So that will give me my revenue. And then I have a favorable sales price variance of $20,000 right over here. Sales price variance is a favorable $20,000. So if I have to find out my actual sales revenue, it will be nothing but the sum of these two, 20,000 plus 10,800 multiplied by 150, and that will give you 1,640,000. So I'm just going to select that option. Right. Now production was dash than budgeted. Now we can see that the material, okay, let's have a look at the variances again. So the material price variance that we have over here is favorable, right? So when we have a favorable material price variance, this indicates that the materials purchased were bought for a price which is lower than how much you had budgeted. So if we look at the gap 6, okay, I skipped to gap 6 first. So coming back to gap 5, so basically let's have a look at our production. For production, let's have a look at our fixed overheads, right? So the fixed overhead volume variance is a favorable amount. The fixed overhead volume variance is adverse. It is 2000 adverse. So when your fixed over, what basically it finds out is that on your production, how much you have produced, so that you are able to allocate your fixed overheads. Now this is adverse, and this tells you that less units have been produced than how much you had budgeted. So I can say that my actual production was lesser than I had budgeted. And to find out my calculation, so to work out that, I will have to take how much is my variance? It is 2000. And how much is the overhead absorption rate? Overhead absorption rate is 20. So that means 2000 divided by 20. That means 100 units less were actually produced, because that is why the variance is arising. Now, we already discussed about materials. So, lesser than standard price was paid because we do have a material price variance as favorable. Now, in using dash budget, so which budget, what are the options that we have over here? 320 kg less, 320 kg less than flexed, more than flexed, or more than original. So, how will we work out our answer over here? We will first see that the material usage variance, let's have a look at the usage. So the material usage variance that we have over here is nothing but adverse. So when it is adverse, it tells you that you have used more materials than you were supposed to. So this is again measured on your standard cost. So if I just take my adverse variance, which material usage is 8,000 adverse, and if I divide how much is the material that is supposed to be used, so this is 25 per kg direct material. So if I just take 8,000 and divide that by 25, that will give me 320 kg. So that means I have used more material again because this was an adverse variance, and I have used 320 more than my flexed budget. So 320 kg more than your flex budget. So with this, we have come to an end to the extra MTQs for your MA exam, which have been provided by the ACCA. Please make a use of these free resources. These are coming directly from the body, and there's no harm. In fact, these are extremely important resources for your preparation for the knowledge level exams. Thank you so much for watching. Catch you in the next one.